following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. Thank you for joining us today on 94.1 FM WNBU and cable TV 10 in New Bern, as well as streaming on the World Wide Web at dlblain.com. We thank you for joining us. If you have any comments or questions on the show, remember the show is about you and your money, so we want to make sure that we're providing topics and information that are relevant to you and your situation. So feel free to give us a call at 252-633-0107. Email us at allthingsmoney@dlblain.com. Let us know what you're thinking. Let us know what topics you may like us to address. You can also visit us on the web at www.dlblain.com. There you'll find information about myself, my firm, as well as archived copies of the show. So let's get right into it today. I wanted to do a quick follow-up from last week. We were talking a little bit about the Occupy Wall Street and the target of Wall Street and the top 1% and who is the top 1%. And we mentioned there that the financial professions do not comprise the majority of the top 1%. I thought it would be interesting to just touch base. One more thing, this came out of CNBC. They looked at the financial executive compensation as a percentage of the company's income. So last week we talked a little bit about the percentage of the top 1%ers and how financial companies are not necessarily at the top. Today, just going to real quick tidbit showing that the financial company, if we look at the CEO compensation, is 0.21% of the earnings of the financial firms. And if we look at some other things like the telecommunication industry, it's 1.08% of earnings. So the financial company CEOs do not earn the largest percentage of compensation based on the earnings of the company. I thought that was also interesting to take a look at. Once again, we strive here on our show to provide you with facts. You make the decisions, but what we want to do is cut through, when it comes to financial information, cut through to some of the facts. And the facts are that the Wall Street CEOs are not overly paid compared to some of the other sectors. Some of the other sectors, consumer discretionary, utility companies, CEOs, 0.51%. So over 2 times, they earn twice as much money as a percentage of the profits of the company as the financial companies is the utility companies. That was from CNBC, from the web. Actually, I think that was a couple days ago, October 11th. So if you want to check that out, it's kind of interesting. The other thing I wanted to talk about this morning, we're going to get into the markets. As we talked about the past couple of shows, after such a disastrous third quarter and September that we've been saying that October, possibly the rest of the year, would be a great time to be an investor in the stock market. And in fact, so far that is borne very true. Anyone that purchased after the lows October 3rd has been handsomely rewarded. One thing I wanted to mention that we're constantly talking to clients about is that investing, whether it be stocks or bonds or real estate or commodities or whatever you invest, is what I call a way to grow your savings. Investing is not a way to, quote, make money. People get that confused. They say, well, here's my, you hear them on, well, here's my $100,000, I want to make some money. Or here's my $1 million, I want to make some money. The returns available in the public capital markets are just not sufficient to make money. They're a way to grow your savings, and you have to have some sort of capital base to begin with. Otherwise, it takes an extremely long time to multiply your money. For example, a 7.2% rate of return, you will double your money in about 10 years. It's called the rule of 72s. Achieving a 7.2% rate of return on average can be very difficult, especially given the particular time period that you're in. What I'm getting at is savings. People simply do not save enough. They look to their 401k balances, they look to their investment advisor, their broker, their financial planner, what have you, and they expect that person to dig them out of some sort of hole that they've created by not saving enough. That if someone is saving, say, 5% of their income, that is just not nearly enough money. If you think you can work for 20, 30 years and save 5% of your income and have that savings available to live on the rest of your life, it's just not going to happen. And so there's a lot of discussions about the capital markets and the returns and what is available, but on an individual level, people seem to forget that investing is a way to grow your savings. If you're not saving, there's nothing to grow. And people that are constantly putting in money, it's more tax efficient. You can purchase asset classes that have gone down. You can rebalance without selling things. It's very tax efficient, but the bottom line is one of the true paths to wealth is you've got to save some of your earnings, whether it be earnings from a job or earnings, if you build a business and sell a business. But the savings rate is largely dependent or is the main factor that will influence whether someday you are able to retire or be financially independent. And I think people lose sight of that in today's economy, everything that's going on in the economy, everything that's going on in the markets, those type of things. They forget that what they do have control over, which is their own savings. And so if you're making $100,000 a year and you're saving $5,000 a year, it's just ridiculous to think that after 20 or 30 years of working, you're going to have enough money to not work anymore. At a minimum, people need to be thinking in terms of 10 to 15% of whatever they make being put aside. I think I told the story last week. When I was a young lieutenant in the Army, I used to save 50% of my pay when I first started out. Of course, that was before I was married and had kids. But that start, some of those dollars are still compounding today. And that's the kind of savings that you need to think about, at least 10 to 15%, because that is going to be the largest determinant of your financial future, not the stock market. But anyway, that's about all the time we have for this first segment. When we come back, we will get into talking a little bit about the stock market. So for All Things Money, I'm your host, David Blain. We'll be right back after a few short messages.